Good afternoon, ladies and gentlemen. Welcome to this session on taxation. We are glad to have you here after lunch. We know this is always the graveyard session at every Congress in the dark after lunch. But we think we have a topic to discuss today that's very exciting, and I think it's very relevant to our professional services that we offer. Taxation, after all, makes up a very large part of the activities and also, of course, of the income of professional accountants. What we're going to discuss today is about an issue that is highly debated in the public today. It's made the headlines, particularly last week again. Aggressive tax planning, countries offering unfair tax competition and unfair tax benefits, and what role have accountants to play in this tax game? I have a very distinguished panel here today that I would like to introduce to you. To my left here is Grace Perez-Navarro from the OECD. She is a deputy director of the Center for Tax Policy and Administration. I got it right. She had many other important functions with the OECD before. Right now, she's one of the most important persons in the most important project that the OECD has undertaken in the last couple of years: base erosion, profit shifting, and as you know, the OECD has come forward just a couple of weeks ago with a number of deliverables and reports, and we have the privilege of hearing really up-to-date where the state of the play is in this field. Before joining the OECD, she was a special counsel with the Internal Revenue Service of the United States of America. Next to her, Stefano Marchese. Stefano is a dottore commercialista, I hope I pronounced it right, which in plain English means he's a tax advisor, an auditor, a statutory auditor, but in particular, he's also a member of the International Ethics Standard Boards of IFAC, and in that role, he is here on the panel. The next guy with the dark beard here, well, he is going to be the bad guy on our panel, if I may say so, because we want to have a controversial discussion. Rob Whiteman, he is the Vice President of the Chartered Institute of Finance and Accounting, and he is, I think, a very well recognized person in the UK, and I think he worked for the UK government. Is going to give us, sorry, I made a mistake now, I have to say, because Bill is shaking his head. He is the Vice President of the Chartered Institute of Accountants. Bill Whiteman is the Chief Executive of TIFA, the Chartered Institute of Public Finance and Accounting. So he worked for the UK government, and he represents the government. And the last, but not least, person is Bill Dodwell. Bill Dodwell leads the tax policy practice of Deloitte in the UK. He is the Vice President of the Chartered Institute of Taxation and the Chair of the Technical Committee of that institute. Bill actually had the pleasure of testifying before the Public Accounts Committee in the UK Parliament, and I hope he's going to share his experiences from that event a little bit later in this session. I myself, Friedrich Rödler, I used to be a tax partner with WC in Austria. I'm now retired, and I'm the chair of the FAA Tax Policy Group, the tax policy group of the Federation of European Accountants. Now, if I can get my first slide up here, it would be great. Here it is. We are in Rome, and as you know, this Congress is about learning from the past. And if you are in Rome, of course, you have to look back to ancient Rome. And ancient Rome had a very efficient tax system. Once they had conquered all these provinces, they were able to exempt the Roman citizens from tax, and all the tax burden was to be borne by the foreigners. However, that system, of course, didn't work very well. It worked the way that the Roman government auctioned off the right to collect taxes to the highest bidder, who then got the right to collect whatever he could out of these provinces, and if it was more than he paid to the government, then of course he could keep the excess. That system worked very well for the government because they got the tax in advance. It worked well for those people who got the right to collect the taxes, but of course it didn't work so well for the provinces. So when Emperor Hadrian came to power, what he did was a major tax reform. And at that time, it was quite easy. And what you can see here is how he did it. What he did, he burned the wooden tables on which the tax debts of the provinces were recorded. And you can find this marble stone, if you want to see it, in the Forum Romanum, in the Curia, where the Senate of the old Rome was meeting. So it shows you, because after that, it shows you that lowering taxes really improves the prosperity of the people. So at least that's something we could learn from them. Taxes were modest. I understand it was mainly on wealth, 1% to 2% on your property, on your houses, your animals, and also your slaves. So at least that's something we do not have nowadays. Now, this is a bit later on. It's not in Latin, so it's not in Rome. It's, you could guess where it is. It's a picture from the building the IRS is located in Washington, D.C., and it says, taxes are what we pay to live or for a civilized society. And I think that's one of the key messages that we are going to discuss also today. So there is more to taxation than just giving money to the government. I think there's something we can expect back from them. Now, being in Rome, of course, one should also look at this gentleman. And back already in 2007, he admonished the people here, in particular in Italy, not to dodge taxes. Of course, in Italy, that was a difficult message to get across. I think since all times, people tried to reduce taxes, but there are some countries, and I hope my Italian friends forgive me, but there are some countries where dodging taxes is almost a national sport, and Pope Benedict at that time tried to convince Italians to be honest with their taxes. But see here what he said. He said, tax evasion is socially unjust. So he didn't say it's a sin which could be forgiven if you repent. It is socially unjust. It robs the state of the means to help the less fortunate. Now, of course, taxpayers, as long as there are taxpayers, they try to minimize taxes, and we are not talking here about those people who are cheating on taxes, who are evading taxes. Today we want to talk about avoiding taxes, legally avoiding taxes, and to what extent is this acceptable or not acceptable. And for that instance, it always needs to tango. So you also need governments who are competing for tax bases, who are competing for investments. And of course, if you followed last week, the headlines, then, sorry, yeah. No? So if you followed last week the headlines, then of course we had a lot of excitement about one country, Luxembourg, being blamed, named and shamed for offering particular tax regimes, fully legal tax regimes where companies could be taxed at 1%. And the question is really, to what extent is this today, in today's environment, acceptable or not acceptable? And if we look back in history, at least I myself, I grew up in an environment where I learned it was completely legal. It was okay to engineer a structure which took advantage of disparities of national tax laws, which took advantage of tax gaps to minimize the taxpayer's burden. And this is a principle that was enshrined in jurisdictions since many, many years. It seems that the attitude has changed. And the other extreme that you can see here is Margaret Hodge, the chair of the Public Accounts Committee in the Parliament of the UK, that accused companies, American companies, I think it was Google, that were taking advantage, full legally, of benefits that were offered by several countries. And what she said, we are not accusing you of being illegal. We're accusing you of being immoral. And that's quite a heavy accusation. I mean, who wants to be called immoral? And so it's good to see that now the OECD, that is taken up this issue of base erosion and profit shifting, companies moving taxable base, moving operations to lower taxed countries and lower taxed jurisdictions, that the OECD is going to take a slightly more balanced view. No taxation or low taxation is not per se, That's the problem if you have a beard, but I hope it's now slightly better. So the OECD is saying low taxation or no taxation is not per se an issue. It becomes an issue if there are artificial structures, if artificially you separate tax base from value creation and from activities. Right, so this is setting the scene for the next 1.5 hours. So we're going to look at what happens here in global cooperation among governments, the BEPS project, the BEPS auction plan, and Grace is going to give us here the actual state of play. But then, in the second part of this session, we would like to discuss, in the view of morality, ethics, what is legal, what is not legal, and how should we, as a profession and individual accountants, when we're advising clients, how should we behave? With that, Grace, I would like to ask you, the floor is yours.